So, I've got something super cool for you today. And I think, honestly, this one could be a good opening episode on Holdfast because on the surface, it looks like a pretty clean bull case. Great business, dominant position, recurring revenue, like it checks every box. But the more you dig, the more interesting it gets. And the more interesting it gets, the more uncomfortable it gets. In a good way, I think.
That's a lot of preamble, Lee. You're stalling. What is it?
Aristocrat Leisure, listed in Australia, ticker ALL. And okay, before I even get into the numbers, let me tell you how this episode starts, because it's such a good story. Their number 2 rival, right, cloned their product, got caught, and was forced to hand over $128 million US, destroy the materials, and pull the games off casino floors worldwide.
Wait, that's not a press release. That's a confession.
Right? And here's the thing. It tells you that what they copied was actually worth stealing. So the moat is real, like a judge said so. The harder question, and honestly the whole episode kind of hangs on this, is if the moat's that good, is the stock worth buying today at around $53?
And those can be, and they often are, 2 very different answers.
Exactly. So, let me set it up properly. At the simplest level, Aristocrat makes slot machines, the physical cabinets, and crucially, the game math inside them, the actual maths that decide how a Buffalo or a Lightning Link game pays out. And increasingly, they lease those machines rather than sell them outright.
Leasing being the magic word there.
It's the whole story, honestly. Picture a casino floor. Aristocrat owns a big chunk of the machines on it and gets paid a slice every single day those machines are running. That's their gaming operations business. Recurring, sticky, essentially an annuity. And roughly 80% of group revenue is now recurring, up from about 72% not long ago.
Okay, so it's not a one-off sale. It's a meter that keeps spinning. I like that. I really like that.
And they're winning. In North America, their share of gaming operations hit a record 43%. The whole group did about $6.25 billion in revenue last year, growing 11%, at a margin north of 40%. This is a genuinely excellent business.
I'm not going to fight you on quality. I want. So let me just ask the one question that actually matters. What am I paying for it? And what does that price already assume?
Okay, hold that thought. I want to make the bull case properly first, because the moat is the part I think people really underrate. Go back to that lawsuit. The court basically validated that the game math, the secret sauce, is real, proprietary intellectual property, legally defensible. That's not some marketing slide. That's a judge in a courtroom.
The courtroom's better evidence than any investor deck. Granted.
So, stack it up. 43% operations share, the industry's biggest research budget, around 13% of revenue, high switching costs because once a casino's floor and systems are built around you, they don't just rip you out lightly. And then there's this little side niche, internet lottery, where they have something like 70% of the US market.
And the backdrop's a tailwind too, right? It's not like they're swimming upstream here.
No, the industry's been genuinely kind to them. US commercial gaming set a record last year, about $79 billion, the 6th straight year of growth. The land-based machines grow low single digits, steady. The online slice is small, but it's growing more than 25% a year, so the pond is fine.
Good, then nobody gets to blame a bad year on the weather. Right, okay, but now back up because you skated past something. You keep saying the business, but it's actually 4 different businesses bolted together, and they are not equal.
Yeah, fair. Let me break it open. The big one, the core one, is the gaming machines and leasing. That's about 3/4 of group profit. That's the financial backbone. Then there's the social casino app business, the Plenty for Fun phone games. Call it roughly 1/5 of profit. And then the internet gaming arm, real money online. That's small, only around 5%.
5. So the thing everyone gets excited about as the growth story is a rounding error in the profit line?
Today, yes, it's an option, not the engine. And I really want a listener to hold those weights in their head because they completely change how you value the thing.
Right, but wait, back up, because you said biggest research budget, 13% of revenue. Why does a company with a moat, a real moat, need to spend that much?
Because, and this is the honest version, it's not a toll bridge, it's a treadmill.
Meaning the moat has to be re-earned every cycle?
Every cycle, yeah. The core hit games, Buffalo, Lightning Link, Dragon Link, they're aging. You need a continuous stream of new hits, or the annuity starts to erode. And here's the bit that I'd really want any owner to sit with. Last year's earnings were actually flattered because their design and development spend came in below forecast.
Hang on. So they beat partly by underinvesting in the exact treadmill that keeps the moat alive?
That's the read, yeah. Spending less on the future today to look better today. And that's sort of the opposite of what you want from a reinvestment-driven moat.
Okay, now can I run the inversion? Because this is where I earn my keep.
Go. What makes this a mistake?
The mistake isn't the business breaking. The business is fine. It's a good business. The mistake is overpaying for quality and calling it investing. So let's talk price. At about $53, what multiple is that?
Roughly 19 times forward earning.
And what's a fair multiple? If you build it up stream by stream, not by just copying what peers trade at.
If you decompose it honestly, the core leasing annuity earns a high multiple. The cyclical machine sales piece earns a low one. The social casino app business is a managed decline. The internet gaming piece is small. You blend out to somewhere around 16 to 18 times. Call it 18 at the generous end if you're really giving them a quality premium.
So the stock is trading at the optimistic top of fair, 19 times against a build it up from the parts range that tops out around 18. There's no cushion, none. And the bear case isn't theoretical. If the social casino decline speeds up and the growth bets stumble, you're looking at roughly $40. That's a 25% drop sitting one bad year away.
And I can't wave that off because both growth legs did wobble. The social casino market is shrinking 9 to 11%. They're actually still gaining share inside that shrinking market, but a melting ice cube is a melting ice cube.
And the internet arm, the supposed future?
Its first half profit actually fell about 11%. Margin sliding from the low 30s into the high 20s.
And the billion-dollar target they'd set for that business?
Management conceded it's slipping behind. State-by-state legalization in the US has stalled. UK regulation, approval timing, it's all running a touch slow.
And there's a second trap here, and it's sneakier. The growth headline is partly borrowed from currency. Reported growth was about 8%. On constant currency basis, it was 16%. And the valuation runs on the reported number, the lower one. So if you anchor to the exciting 16%, you're paying for growth the actual earnings don't fully show.
That's fair, and that's exactly why the analysis deliberately models the lower reported figure.
And one more thing, people keep calling this a net cash fortress. It isn't anymore. Net debt roughly doubled in 6 months, from about $400 million to over $900 million, to fund buybacks and bolt-on deals.
True, though I put it in proportion. That's still only about a third of a year's earnings before interest and tax and debt. Roughly 3% of the market value. It's low leverage. It's just not a fortress anymore, and it moved the wrong way.
Fine, I'll take low leverage, not fortress. But notice the pattern, because this is the part that should make you uneasy. They expanded the buyback by $1 billion on the same day the stock jumped 13%.
Buying more back, size in dollars, on a green day.
That's the tell, right? And it rhymes with history. Back in 24-25, they were buying their own stock at 60 plus, at 25 to 30 times earnings. That destroyed value, buying high.
To be fair to them, the current buyback, around 18, 19 times, is reasonable, and shrinking the share count about 3% a year is real value when the price is sane. But yes, the instinct to lean in as the price rises, that's exactly the thing to watch.
So here's my charge, right? The whole bull thesis on the street rests on two human errors wearing a suit. One is plain overconfidence, anchoring to your own rosy number and underrating the drawdown. That's the classic engine of overpaying for a great company. And the other? Social proof. The analyst consensus is buy, even strong buy, with targets of $63 to $74. Everyone owns it, everyone likes it, so it must be right.
But those targets are built on a roughly 29 times terminal multiple, the bubble multiple this whole analysis rejects.
And that's the real disagreement, isn't it? The bull and the bear here don't even disagree about the business. They disagree whether the price already pays you for it.
So, settle it. How does this kind of analysis actually decide?
First principles, and one clean test. Forget what it should trade at by comparison. Ask what the business yields you, here today, versus what you'd get risk-free.
The earnings yield against the bond test.
Exactly. At 19 times, the earnings yield is about 5.2%. The Australian 10-year government bond is sitting around 4.8%, and the central bank hiked 3 times this year, so the market expects rates to stay high. So the extra reward I get for owning a cyclical, regulated, currency-exposed equity instead of a government bond is
About 0.4%.
0.4. That's the whole risk premium for all of that. The treadmill, the wobbling growth legs, the currency borrowed, the cyclicality.
That's the number, and it really is the heart of it. Run the scenarios. A bear around 40, a base around 50, a bull around 63. Probability weight them, and you land at a fair value of roughly $51.
And it's trading at 53.
A few percent above fair. So the way this analysis frames it, a wonderful business priced at fair to full. No margin of safety, which is very different from the kind of setup where you're paying 8 times earnings for something below book value. This is the opposite of that.
And notice what we said. Here's what the price assumes, and here's the cushion, which is roughly 0.
Which brings us back to the one lesson, and it's really the payoff to that opening lawsuit. A great moat tells you what to admire. It does not tell you what to pay.
Say the whole thing.
A wonderful business at a full price may not be a wonderful investment. The quality compounds, but the price you pay still decides your return. You can be completely right about the moat and still hand over too much for it.
And the discipline that follows, it's just patience. The fat pitch window for this one was open a month ago, down in the mid-40s at the lows. It rallied about 15% and closed. The reasoning doesn't say chase it. It says know your number and let the price come to you.
Wait for the fat pitch. Munger would approve.
He'd approve of the patience. He'd be suspicious of anything everyone already loves.
On that note, the disclaimer.
This is general information and education only, not personal financial advice. It doesn't consider your situation. Do your own research or speak to a licensed advisor before acting.
Admire the moat. Respect the price. That's Hold Fast for today. We'll see you next time.